Welcome back to The Explainer. So, today we're putting on our senior equity analyst hats and diving into something really exciting. We are running an exhaustive multi-model valuation on 18 mega-cap stocks from the S&P 500. We're talking the big players, excluding the usual tech giants. We're applying a strict Warren Buffett-style value investing philosophy here. Why? To cut right through the market noise and uncover true intrinsic value. Let's quickly trace our path for today. We'll set the value investing landscape, demystify our valuation models, run these stocks through Buffett's 5-pillar framework, do some thematic deep dives, outline actionable conclusions, and wrap up with the very real limitations of these models. Let's get right into it. Starting off with Section 1, the value investing landscape, featuring our executive summary. Skipping straight to the punchline, our Naster synthesis reveals a really clear divide. On one hand, you've got Salesforce and Gilead screaming undervaluation across multiple metrics. They're throwing off incredibly strong buy signals. On the flip side, premium quality names like KLAC and Texas Instruments are flashing bright red. They're significantly overvalued right now. But, to really trust these signals, we need to understand the machinery behind them. Which brings us to Section 2. Let's demystify the valuation models and see exactly how we measure intrinsic value. All right, our heavy hitter is the discounted cash flow, or DCF model. In plain English, this just calculates the actual cash a business will generate in the future and discounts it back to what it's worth today. This model is exactly what exposed Salesforce's massive undervaluation. Multiple independent DCF models converged on an intrinsic value between $306 to $471. Compare that to its market price of roughly $184, and wow, the cash flows just absolutely dwarf the current price tag. Next up, we use EV to EBITDA. This looks at total enterprise value relative to operating earnings. It's a fantastic metric because it strips away all those messy accounting distortions and debt differences. It lets us see the raw underlying cost of the core operations. And applying this lens, PepsiCo suddenly jumps out. It's sitting at its cheapest level in half a decade, with a 13.4 multiple. That is a huge historical discount. Then we bring in the PIG ratio, which adjusts the classic PE ratio for expected earnings growth. Here's the golden rule. A PIG under 1.0 means you are literally paying a discount for future growth. Out of all 18 megacaps we analyzed, only 4 hit that coveted milestone: AT&T, Citigroup, Gilead, and Salesforce. Now, to give you some perspective on the absolute other extreme, consider semiconductor giant KLAC. It's currently trading at a jaw-dropping 52.9 times trailing earnings. That is nearly double its historical median. The market is pricing in this massive, permanent demand shift for AI, which means, essentially, the stock is priced for absolute perfection. There is zero room for error here. Moving to Section 3, Buffett's 5-pillar framework. Let's apply the Oracle's logic to these numbers. So, Warren Buffett relies on 5 crucial pillars. 1. Consistent return on equity above 15%. 2. Highly predictable earnings. 3. A durable economic moat. 4. A real margin of safety. And 5. Exceptional management and capital allocation. This framework is absolutely brilliant at separating truly wonderful businesses from dangerous value traps. When we zero in on Pillar 1, that return on equity, the contrast is mind-blowing. You have elite capital compounders like TJX cranking out an unbelievable 59% ROE thanks to their highly efficient asset-light model. Compare that to a business burdened by massive debt like Verizon, which is scraping by at about 9%. Remember, Buffett demands genuine, business-driven returns, not just leverage-driven mirages. And when you cross-reference a company's moat durability with its margin of safety, the winners become crystal clear. We can easily identify high-conviction ideas, like Salesforce boasting a wide moat and a massive safety margin, and clearly separate them from struggling players like Intel, where the moat is actively eroding and there's basically zero safety net beneath it. Let's jump to Section 4. Time for some thematic stock deep dives into telecoms, consumers, and turnarounds. First, the classic telecom duopoly, Verizon versus AT&T. Now, both of these are trading at absolute bargain basement multiples and offer fantastic dividend yields. But AT&T actually presents the slightly more compelling value case today. Why? Well, following its Warner Media spinoff, the company has refocused its core business beautifully, resulting in a highly attractive 0.8 PEG ratio. It's simply the better growth-adjusted value right now. Next up, let's look at 2 major turnaround stories, Disney and Intel. This is the tale of 2 very different risks. Disney gives us a wide economic moat, a newly profitable streaming division, and an unrivaled IP library, all sitting at a 57% discount to its 5-year PE average. Intel, however, is a massive, binary gamble. You're betting on a highly uncertain, unproven foundry turnaround, while their competitive moat is actively under siege. Then we face the great paradox: premium quality versus tech monopolies. Companies like McDonald's, TJX, and KLAC are the exact types of dominant, high ROE cash machines that Buffett adores. But here's the catch: they are priced at levels he would absolutely never pay. Whether it's a permanent quality premium for consumer defensives or intense AI-driven multiple expansion for semis, these sky-high valuations completely wipe out any margin of safety. All right, Section 5. Let's distill all this data down into actionable investor conclusions. Okay, here are the standouts. The specific stocks I would buy today: Salesforce, Gilead, and Disney. These three feature highly visible margins of safety across multiple valuation models, Salesforce especially, and they combine that cheap price tag with durable, heavily protected economic moats. Basically, these are wonderful businesses currently trading at wonderful, or at the very least, highly reasonable prices. Then we have our watch list, the premium quality names where you need to wait for a 20 to 30% pullback. Look, companies like McDonald's, Kellec, Texas Instruments, and Linde execute flawlessly. No one denies that. But because the market currently prices them to absolute perfection, buying now is just too risky. You have to cultivate the discipline to sit on your hands and wait for a broad market correction to create your entry point. On the other end of the spectrum, here are the stocks I would avoid entirely right now. Intel, because of those binary turnaround risks we talked about. Citigroup, which might look tempting below book value but has suffered decades of chronic underperformance. And NextEra Energy, where standard DCF models are just fundamentally distorted by negative near-term free cash flows. I'm staying far away from these due to deep structural uncertainties. Finally, Section 6, the appendix on model limitations and the margin of error. We have to be radically honest about the flaws in our own formulas here. The DCF model is hypersensitive. Tweaking terminal growth by literally just 1% can wildly swing your intrinsic value output. EV to EBITDA completely ignores real depreciation costs, which is super dangerous for asset-heavy businesses. And the PEG ratio? Well, it relies on analyst growth estimates, which are notoriously unreliable. Every single model has a blind spot. That's exactly why we demand convergence across multiple metrics before making a call. And of course, I have to emphasize this. This report does not constitute investment advice. All models rely on assumptions that may prove incorrect, and all valuations are estimates, not facts. Valuing a company is ultimately an art of estimating the future, not a hard science. Please consult a licensed advisor before making any major financial decisions. So, I'll leave you with this one critical thought. Do you have the discipline to wait for the perfect price? Identifying a wonderful business is honestly only half the battle. Having the immense psychological restraint to wait patiently for the right price, that is what truly separates the greatest investors from everyone else. Thanks so much for joining me for this explainer, and stay focused out there.